They said you're addicted to love. See the signs, but you can't read. All right, hello, hey, it's Fred Atwater here. A little bit of an intro there. You're addicted to love, and in this case, it's LUV, Southwest Airlines, and that's my kid's. He's a 5-year-old, and we have several of these airplanes that he plays with. And thank you to the Southwest Airlines employees that took us on a trip this weekend safely around the country. They got a really good business model, really strong. All the airplanes are similar make and model. Keeps their maintenance and keeps their turns very good. And one of the industry's leading top airlines for employee happiness. And I think that employee happiness makes for a fundamentally very strong company. And on the chart in front of you here, you can see it makes for some technically accurate entry points on the stock as well. This is LUV up here. You can see on the entry symbol here, and this is a weekly chart that you're looking at. We've done a couple trades on this over the last 2 quarters, the first quarter of the year, second quarter of the year, and that first quarter entry we did right here. This was a box that we had published as the entry point before that box happened, and it did happen, and we went long on it, and then we got out right there at the end of the week for a very nice profit on that. Stock continued to run up, and then it retraced back down, and then guess what? We waited for it to show support, and it showed support right on the 20, and right there we went long again. When I say we went long, we went bullish on the stock. What we did on that second trade, which we're technically still in, we went and bought the $45 January 2019 strike calls. And against those, at that time when I entered in April, I sold the $60 strike calls against them to reduce my cost basis. In addition to, I had already reduced my cost basis on the LUV calls because I had taken profit right here on a share buy and a share sell. That was 1,000 shares that I had bought and sold there, and made a very nice profit on that. The stock progressed here. It came up to this level last month, and I bought back the short calls for pennies, and then I sold again the June 60 strikes. So I've had 2 months of selling the 60 strike short calls against my long calls, and they've made money both times. And what really makes money is these $45 January 2019 calls. Now, what's getting ready to happen here? The trade price on Southwest Airlines is about $60.99. I was gonna say 61, 1 penny off. It closed at $60.99 today. So what I'm gonna do come next Tuesday, I'm going to buy to close the $60, and I will most likely resell the July 60s for what's called an NCC, or a net credit to cash, when I do that, because the stock's gone the right direction, and it hasn't explosively gone too much the right direction, which sometimes requires a net debit to cash, which is an okay maneuver as well. Let me show you a trade, what that looks like on the trade board here. Click here, get the mug shot out of the way. All right, and then these little flag markers here show, they're a quick reference to me to tell me where my positions are. The green is a long position, the red is a short position, so I'm in a what's called a long call diagonal on this stock, and I am in possession of, I own control of the shares here at the $45 strike price. And you can see here there's a delta of 0.82. You can't really see that as I scribbled out through it, but that means that this contract is moving at 82% of the price of 100 shares of the underlier, which is technical speak, but it means that it's doing very well. I get 82% of the performance, but look at the price of the contracts at the mark price of $19.05 as opposed to $61 or $60.99. Notice those two differences. This thing costs about 1/3 of what buying 100 shares is. I can buy control of 100 shares at 82% power for a 1/3 of the cost, and then I go over here and I sell what I did was the stock was below $60. I think it was like 57.5, 58, something like that when I sold these 60 strikes. And there they are right there. They're at $1.57 right now. They're slightly what's called in the money, but that's okay. I'll buy them back at $1.57, and what I said that I would do would be to sell the July $60 strikes, which are right here. These are called at the money because they're right commensurate with the trade price of the underlier. And these ones are going for $2.57. So I can buy back at $1.57 and sell at $2.57. The net credit will be better than that come Tuesday because I'm going to wait a few days, and I'll probably get about $1.25, $1.30, something like that on the net credit to cash. And that is how that works. That net credit to cash goes over here, and it does this. Let me show you this real quick so we don't run out of time. I'm going to show you the analyze graph. The net credit to cash works very, very well for you because what it does is reduce this price right here. So this green line is the net underlier, or sorry, the net call, long call position. Original purchase price was $15.30. Okay, that's $1,530 per contract times 4, which is about 6,000 and change, 6,100, something like that. But because of net credits to cash and the profits I got from buying and selling the shares straight up, I've been able to reduce my cost basis down to $10.69. And if you actually subtract these two out right now, my adjusted cost basis is sitting down here at $9 and whatever that is, 89 cents. That's pretty cool because that $9.89, and I take another net credit at $1, it'll reduce my cost even further to $8.89. And all it does up here on this graph is make the profit section of this bad boy grow. This purple line and the intersection of this dotted line is my current theta decay intersection with the trade price. Current trade price is $60.99. Whoops. All right, and let me just before I get too many squiggles going on here. Boom, right there. And then if I go across here on the y-axis, you can see my current profit is sitting right at about $2,900, $2,850 something dollars like that. This little space right here is nothing more than the theta decay that's occurring in the last week prior to expiration. That's really long, really kind of an explanation there, but that's exactly what that is. That's awaiting profit on the expiring contracts there. All right, that is about it. We're going to run shy on time here. Let me go back to that. If I didn't do it already, here is a book for you, Trading in the Zone. Mark Douglas. Get it, read it. It's a great book. All right, it talks about the mindset and the lack of fear and how to develop confidence for you in the market so that you can actually profit from this stuff just like I do. And it works, guys. You can be as wealthy as you want to be in the market. You just have to trust in yourself and learn how to do it. Charts like this are nothing more than the ability to read market sentiment. It doesn't really matter what you think the stock should be worth. It matters what everybody else thinks the stock is worth, and that you can read that. And if it's going up, that you can go with the trend. And if it's going down, you can get out, or you can go with the trend on the downward side. There's techniques to do that as well. All right. Thank you, guys. I'm going to wrap this up, and you guys have a great rest of your week. Your heart beats double time.